Good morning and welcome to today's 5 with Fitz. I'm Keith Fitz-Gerald. Thanks as always for joining me. Let's cut right to the chase today. Markets are green as I record this, but many investors are worried about a pullback at the moment. And I get it if you're one of them. That's normal, by the way. But please do keep this in mind. The biggest profit potential is always found at the edge of absurdity, which is why you'll want to keep your emotions out of the equation at all costs. And if you can't do that, if you can't keep your emotions out of the equation, believe it or not, it's not the end of the world. Have a plan, set goals, execute, adjust, and repeat. It really is that simple. Here's my playbook today. Number one, should investors continue to chase markets higher? Well, I joined my good friend and colleague, the super savvy Scott the Cow Guy Shelley, for a thought-provoking conversation yesterday about whether or not investors should chase stocks higher. Now, Scott also hit me with a great question about potential pullback and, of course, valuations. And you can watch that video elsewhere on my channel. I hope you do because it was a great, wide-ranging discussion, and Scott is super smart. Now, the thing about this is that my perspective may surprise you like it does a lot of people who forget their history or who simply aren't or weren't familiar with it in the first place. Keith's investing tip in this department, you have got to be in to win if winning is what you want to do. Playing not to lose won't cut it, even though most folks think that's what they should be doing. It is no wonder very few achieve the results they deserve. Now, here's a trading idea, and I mean it, not an investing idea, a trading idea. I do smell a short-term rug pull in the wings, and while that sounds scary, it's an opportunity for both traders and investors alike. I want you to be ready for that mentally and get your buy list out because chaos always creates opportunity. Putskis and low balls for the win. All right, number two today, pills, profits, and the illusion of privacy, Amazon's real prescription play. Now, here we go again. Amazon is at it again, this time with prescription vending machines inside one medical clinics. Now, you walk in, you see your doctor, you scan a code, grab your meds on the way out. Impressive as heck until you realize that hospitals and CVS have been doing this for years. Now, once again, Amazon's just rebranding convenience and calling it innovation. Think about that. And here's the thing you want to think about as an investor. Nobody really needs a prescription vending machine. What we need, particularly in this country, is affordable care, transparent pricing, and doctors who have time to listen, none of which is Amazon's doing or fixing. Oh, and while I'm at it, insurance companies that aren't thinly disguised highway bandits, but that's a story for another time. The real story here, and the investing one you want to focus on, isn't healthcare, it's data, something that we've been talking about for years. Every prescription and diagnosis runs through Amazon's system, giving the company another window into how you live, what you buy, and where you spend your money. Contrast that with Apple, which is quietly building a preventative health ecosystem that people actually trust. What a concept. Anyway, I know which stock I'm going to be buying. Do you? Question of the day. Number three, Tesla. It's not the $25,000 car maybe you wanted, but it'll be the $600 plus stock you wish you'd bought. We've been talking a lot about Team Musk lately, and for good reason. Tesla just rolled out its new standard versions of the Model 3 and Model Y at $36,990 and $39,900. $990 if memory serves. Anyway, unfortunately, these are not the long-awaited $25,000 Teslas that everybody's been drooling over. They're in-betweeners, meaning that they're another smart, calculated play to keep Tesla's lead alive while the company gears up for its real next act, the next generation unboxed platform that is widely anticipated to cut costs by another 20-25%. Now, Wall Street, of course, is already grousing about this, right? Oh my God, these cars aren't as cheap as we want. They're not going to sell, blah, 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 blah. Yada, yada, yada. What they're missing is that every 10% drop in price roughly doubles the amount of people who can afford a Tesla, according to my back of the envelope math. And that, in turn, means that roughly another $10 to $15 billion in incremental annual revenue potential. I mean, you don't see those kind of numbers very often. So, bottom line, bet against Musk if you like, or you just simply don't like the guy. I get it. I'm not. $600 a share. All right, number four. Sun, as in Masayoshi Son, wants AI's body, and I'd rather own its brains. The company's shelling out $5.4 billion to buy ABB's robotics division. Masayoshi Son calls it the next step towards what he's deemed physical AI, merging robots with artificial intelligence to propel humanity forward, which is great. Tesla's been working on that with Prime and Optimus and everything else for a long, long time. But, we'll give him his day in the sun. SoftBank already owns ARM and is buying Ampere and has stakes in OpenAI and Oracle Stargate project, right? Now it wants the robots too. On paper, this is a brilliant move, but my 2 cents is that Sun's track record is mixed, at least in the early going. For every Alibaba, there's a WeWork, right? So that's why I'd rather own the companies building the AI hardware at this point in the game than the one trying to own everything, if that makes sense. Now, the robotics market could top 250 billion by 2030, a number that I think is a tad too conservative, almost laughably so. But not everybody's going to make money doing that, right? Hopefully you've got this covered with your own investing, because odds are good that you will not get a second chance for decades if you sit this one out. Now, if you're not, and you have no idea, and you'd like some help, you might enjoy one bar ahead, just like thousands of other smart investors who tell me it's helped them gain the confidence they need to navigate today's complicated markets. Never any pressure, and never will be. I'm just saying, I'm here if you need me. Number 5, cell towers just left the planet, and the smart money's already in an orbit. Verizon just signed on with AST Space Mobile to beam cell service straight from orbit starting in 2026, as in next year. I mean, this stuff is accelerating so fast it makes your head spin. Investors who think about space as a someday proposition are already missing the boat, or in this case, the rocket, quite literally. So invest in local communications companies if you want. The bigger and considerably more profitable prize is a global internet, something that Grandview, a consulting firm, pegs at 2.87 trillion by 2030. Now, again, I think that figure is also laughably low. But that's just me and a story for another time. Meanwhile, Verizon and AST are interesting investing choices, and I'm happy to be farther into the value chain and earlier in the game with some other choices, as is the OBA family. Leaps on both Verizon and AST could be interesting, but I'd be inclined to wait for the volatility to taper off so as not to overpay if possible. Today's bottom line is super simple. Do not chase yesterday's trends. Instead, position for tomorrow's inevitabilities. As always, let's make it a great day. You got this, I promise. Thanks for watching, and I'll see you tomorrow. Cheers.